Have you ever wondered how a trader with just $1,000 can move hundreds of thousands in the market? It's not magic. It's something called financial leverage, a tool that can multiply your profits, or your losses, just as fast. Today on Mix Mind 79, we're diving deep into the world of leverage. What it is, how it works, and why it's both a trader's dream and a nightmare. YouTube full script. Omek Stein, under Bein ID Mix Mind 709. 1. The basics of financial leverage. Let's start simple. Leverage means borrowing money to increase your market exposure. It's like controlling a car worth $100,000 while paying only $1,000 up front. In trading terms, if you use a leverage ratio of 1:100, your $1,000 can open a position worth $100,000. You still need to deposit that $1,000 as margin, a form of collateral, but everything beyond that is borrowed from your broker or trading platform. This sounds exciting, and it is. But it's also where most traders underestimate the risk, because while leverage can amplify profits, it also magnifies losses. Let's make it real. If the market moves 1% in your favor, with 1/100 leverage, you make a 100% profit on your capital. But if the market moves 1% against you, you could lose everything in seconds. That's why leverage is often called a double-edged sword. It cuts both ways. And, when your losses grow too large, the platform triggers something called a margin call, closing your trades automatically to prevent further losses. At that moment, your balance might already be gone. 3. Different types of leverage. Leverage isn't the same everywhere. In Forex trading, leverage is often the highest, sometimes up to 1/500 or even 1/1000 in unregulated markets. That's why it attracts many retail traders who dream of quick profits. In stock markets, regulators keep it much tighter, usually 1.2 or 1.4, because of the higher risk of volatility and manipulation. Then there's the cryptocurrency world, where leverage has reached extreme levels. Platforms like Binance or Bybit offer up to Bein on Paintain, Ein Bein on 25 Bein from 5, letting you control huge positions with tiny deposits. In the world of DeFi, decentralized leverage happens automatically through smart contracts, without brokers or banks, pure code managing billions of dollars. 4. How leverage actually works. So how does all this work behind the scenes? When you open a leverage trade, your broker reserves part of your balance as margin. This acts as a safety net in case your trade goes wrong. If the market moves against you too far, the broker issues a margin call, or automatically liquidates your position. Modern trading platforms monitor this in real time using algorithms and AI. They constantly calculate risk, price changes, and exposure to prevent total collapse. 5. The rewards and the risks. Leverage offers incredible benefits. You can trade larger positions, diversify your portfolio, and profit from small market movements. That's why professionals and institutions use it strategically, not for gambling, but for capital efficiency. But the risks are equally serious. High leverage can destroy your account faster than you expect. Emotional trading, greed, and fear only makes it worse. The golden rule: never use more leverage than you can afford to lose. And always use stop-loss orders to protect your capital. Leverage doesn't forgive mistakes, it magnifies them. 6. Traditional versus digital markets. In traditional markets like the NYSE or NASDAQ, leverage is heavily regulated. You can't just use massive ratios. Brokers must follow strict financial rules from regulators like the SEC in the US or the FCA in the UK. In contrast, digital platforms, especially in crypto, operate with much more freedom. This innovation came from Fintech, blending financial systems with digital technology. Thanks to this evolution, leverage is now accessible to anyone with a smartphone. But that accessibility also means higher personal responsibility. Fortunately, AI is making trading smarter. Some platforms use machine learning to detect volatility, automatically adjust leverage, or warn traders before markets crash. There are some. 7. Legal and regulatory dimensions. Not all leverage is created equal, and not all of it is legal everywhere. In Europe, regulators limit retail traders to a maximum of 130. In the US, rules are even stricter, but in Asia and the Middle East, some markets allow higher ratios, especially for experienced traders. The problem comes with unregulated platforms, those offshore exchanges that promise extreme leverage but offer little protection. Many traders have lost entire accounts when such platforms vanished or froze withdrawals overnight. That's why experts always advise, trade only with licensed and transparent brokers. Saprutrapper. 8. Who uses leverage, and why? It's not just retail traders chasing quick profits. Large corporations and investment funds use leverage too, but differently. They borrow money to finance expansion, acquire assets, or hedge against risk. For example, a company might use leveraged loans to build new factories or develop products faster. In finance, this is known as corporate leverage, and when done right, it can accelerate growth dramatically. But history also shows the dangers. In 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize winners, collapsed after using extreme leverage. The losses nearly triggered a global financial crisis, a reminder that even the smartest minds can be undone by too much borrowed money. 9. Leverage in the Fintech Era. Today, Fintech is transforming leverage. Apps like eToro, Robinhood, and Binance Futures let users access leverage instantly. With real-time analytics and risk dashboards, artificial intelligence now helps traders identify the optimal entry and exit points, and even adjust leverage automatically based on market volatility. We're entering the age of smart leverage, where data and automation can make trading safer, if used wisely. And as blockchain technology continues to evolve, decentralized leverage systems in DeFi are becoming more transparent and programmable, potentially eliminating human error and fraud. 10. The final word. Leverage is not a scam, nor a shortcut to wealth. It's a financial amplifier. It magnifies whatever's already there, your skill or your mistakes. Used correctly, it can build fortunes. Used carelessly, it can destroy them. In the future, as AI and financial regulation grow hand in hand, leverage will likely become safer, smarter, and more transparent. But one truth will never change. Knowledge and discipline are your real leverage. Thanks for watching MixMind 7290, where we decode the technologies and forces shaping the future of finance. Don't forget to like, share, and subscribe. And remember, trade smart, not hard.